Hello, welcome to Raise Capital Like a Pro, exclusive strategies to raise capital and build wealth. In this summit, there will be over 20 experts who will be sharing their insights, their knowledge, their systems, everything that they have done to raise capital and build wealth. I am your host, LeAnn LeFortūne, and you will also hear my co-host, Jeff Tyson.
Our next guest and speaker, she is seasoned investor, entrepreneur, and legal expert in M&A and security law. Over the last 15 years, she has built and scaled and exited multiple businesses, earning recognition as a BV, top 40 under 40, and features in publications like the Wall Street Journal, LA Times, and Forbes. She has been both a GP and LP investor across various asset classes, and now leads a real estate private equity fund focused on land development in the U.S. Today, she's going to share a little bit about how her focus is on passive real estate investing through a private equity fund. So give us 1 second here, and we'll get her up here for you guys. And Dave, what an amazing piece of information Dave has left, and everybody has done so far. I mean, Dave, you weren't sleepy at all, man. I'm excited. I'm wide awake with all the things that you talked about. All right, here we go. Our next guest, Alice Chen.
There she is. Hi, Alice. Thank you so much for joining us today.
Yeah, my pleasure. Thanks for having me.
Yeah, absolutely. We're going to jump right in. I know that you're quite an accomplished lady. I mean, Jeff just read a little bit about you. Can you tell us more about your background?
Sure. Yeah, I started out as a lawyer in Canada. So I practiced in corporate law, mergers and acquisitions, securities. So working on IPOs, working on equity financings, and just a lot of, drafting documents. So being a corporate lawyer means that I like paperwork, but I love investing, but don't like tenants, toilets, renovations, hammers. I don't do any of that. So here I'm talking to you and everybody about investing in real estate passively.
Great. Yeah, no, I'm with you. I'm with you on that. Except for I'm not a paperwork. I like that. I don't want paperwork, so I'm not there. Why is private equity your favorite asset class?
I love it because you get to work with experts. So of course, as an investor, you always want to do, your own due diligence. You want to look at who's the GP, that's a general partner. So in a private equity fund, there's basically two types of people. So there's the GPs, general partners, that do the work or execute on the fund strategy. And then there's the LPs, limited partners. So limited partners are the investors that write a check. So I've been both, and oftentimes, even though right now I run my own fund, I'm still LP in many other funds and I continue to look for opportunities. So I love private equity because, as I said, I'm not really very handy, nor do I actually naturally have the inclination to do home improvement. So, options like fix and flips and even, other options like wholesaling and just very kind of hands-on active real estate, it's not really for me. So I think there's a world out there for people that want to have exposure in real estate, want to learn a little bit more about finance and want to get into the world of alternative investments. There's a world out there where people want real estate exposure, but don't need to be super hands-on.
Yeah. So why do you focus on the land development thesis?
Yeah, so it's interesting. You asked me why, I like the real estate, the private equity asset class. It's because, you can invest into different strategies through a fund structure. And for us, we're a firm that originated in Canada. And because I'm a partner that, travels to the US and works in the US, I've been leading the US market efforts. And so we've spent the last couple of years actually really digging into different strategy. So we looked at value add multifamily in Texas for a year, and then that was in 2022. And of course, the interest rate started to hike, which wiped out a lot of equity in the deals. A lot of deals don't really pencil anymore. So, luckily we didn't get into that strategy. And the last couple of years, we looked at different things, and I think just by chance, we happened to have met a great land developer partner about a year ago and started to really study the strategy. So what we do is we become capital partners to land developers that turn raw land into finished lots for national home builders, often these are public companies, companies like D.R. Horton, Lennar, the companies that you would recognize the name if you drive around construction sites. So land development is two parts. It's land entitlement as well as horizontal development, which means you're putting roads and infrastructure onto the raw land so that it becomes finished lots for then national home builders to come in and do the vertical construction, which is the construction of houses or towers. So we love the area of land development because it's, first of all, it's not something that is widely known and it's hard to execute. Like you have to be from this space, for a while to be able to kind of be plugged into the deal flow. So the way that we do it is that a national home builder or a very skilled home builder would be calling our land development partner, and they would say, hey, we have this piece of entitled land. We want to build 500 homes on this piece of land, right? Maybe 1,000 homes, 2,000 homes. It depends on the data. Everything's very data driven. They know that there's the demand. They know that there's the migration numbers to support that thesis. And so our land developer will then buy the land from, let's say, a D.R. Horton, for a specific price. So let's say they buy it for like $20,000, $30,000 a lot. And then they know that when they finish the horizontal development 2 years later, we typically pick projects that are a little bit shorter term, like 2 to 3 years, just because there's so many changes in the world these days, a lot of macroeconomic changes, different things going on. So we try to really stick to shorter duration projects. And so our land developer partner knows that on day one, they have a signed contract. It's a forward purchase contract with a national home builder. They know that, okay, we're buying it at $30,000 a lot, but once we're all done with a horizontal development, we're going to be selling that, or D.R. Horton is going to be buying it back at $70,000 a lot. So your profit from day one, and you have a contract from day one. So it's an amazing business model where the exit is already built in. And I mean, I've been, a serial founder and entrepreneur business owner for 16 years. I have not seen a situation where you have a contract in hand. So you have the exit that's built in from day one. So we love this thesis because of that.
Yeah, I know, that makes sense. Is there a reason why you're only doing it in the United States and not in Canada as well?
Just because it's such a huge opportunity. Like in Canada, we do different things. And it's interesting because real estate is hyper local. So what makes sense for one geography may not translate to another. So for example, in our hometown of Vancouver, BC, we focus on multiplex development. So this is turning single family lots into a fourplex, into a sixplex. And that's because Vancouver, if you think about it, if you look at a map, we're sandwiched between ocean and the mountains, right? So very, very blessed to be in that situation. But at the same time, that means that we don't have more land to build on. Like that's it. And so you got to go up, you got to increase that density. And so for a place like Vancouver, and then now I know the strategy is very popular, for example, in Seattle area, in San Jose area, in San Diego, we focus in the metropolis, like the metro centers like that. In similar situations where land is very constrained, we focus on multiplex development. But, in a lot of the states that we focus on, these are Sunbelt states, Texas, Florida, the Carolinas, Kentucky, Tennessee. For those states, there's a lot of demand for single family homes, and they still have a lot of land, right? So, why not build a single family homes? And I think there's also significance in what we do. Like I always think that home is really, where you and your loved ones kind of gather. It's where you express yourself, right? So it's where you have your sanctuary. So to be able to provide or be part of the supply chain, the value creation chain that provides that for people to fulfill their American dream, like that's a really good thing.
Yeah, absolutely. What do you look for when evaluating a potential investment in land development?
So of course, as I said, we're very data driven. So it's never the case where we speculate on a piece of land and then we hope that, okay, by buying this piece of land, even if we're buying it at a discounted price, we then hope that if we do a bunch of work on it, we hope that it's going to be sold. No, we don't do it that way. We do it in a reverse engineering way where we get calls or invitations to participate in a bid by the national home builders or a scaled home builder. that's, maybe more regional in size or more local in size. So then they tell us this is where we are planning to build our next master plan community. This is the product type. We're building these type of houses, but we're building 500 or building 2,000 at a time. And then can you guys go and work on the entitlement, or can you guys go work on the horizontal development? So it's always that reverse engineering pathway and wanting to make sure that the exit is built in by contract on day one. So that's what we look for.
Okay. So can you tell a little bit more about what is in your due diligence? Like what exactly do you, what data points, are you pulling in exactly? Do you have like a few of those?
Yeah. So as a private equity firm, we have a very extensive due diligence process. We used to have a 40-page, manual on how to evaluate companies. 10 years ago, in a different fund, we were actually buying companies. So it's actually way more variance and also moving parts. So I actually prefer real estate because it's more straightforward. So right now we have an 8-page due diligence, process where we first of all we have to look at the land development partner, right? So there's operator due diligence. What's their track record? What's their team like? What's their team capacity? What's their team, collective track record, and what's their orientation? Like, are they oriented in a way to help them scale? Because sometimes when you have a capital partner injecting capital, but you're not ready to scale, then you could fail also as an operator, right? So it's quite a leap to go from a mom and pop operation to a scaled operation with outside capital. So not everyone's going to make that leap. We look for partners that have leaders in the organization that can make that leap. But of course, on the project level, there's a lot of due diligence we have to do. We have to verify the data, the market data, geography data. We have to look at a lot of the legal paperwork, right? So like my business partner, the other GP in the fund, he has a CPA, he's an accounting background, right? So 24 years in accounting and corporate finance and private equity. So he will do a lot of kind of audit-like process to verify the data and the numbers. I have a legal background, so I scrutinize all the legal documents and even help participate in the negotiation sometimes if the situation calls for it. So it's just, layers and layers of different considerations. And of course, every investment, every project we invest in will have to pass through the investment committee process. And then we deploy the capital. What's great about the fund is that it's not just a singular asset. So a fund will typically, invest in multiple projects, but with under the same thesis. So that way you're diversifying across the different projects, sometimes across different operating partners too.
Yeah, definitely. I do like that about funds. What are some common mistakes new investors make when structuring a private equity fund, and how can they avoid them?
Yeah, so I teach a masterclass in private equity formation, so the basics of fundamentals of private equity fund. And you can find my masterclasses on my YouTube channel. And to get to that, go to my personal website. It's AliceChenCompanies.com. So that's ALICECHEN companies.com. So all the information is there. My own, biography is there, more information. You can find a lot of educational materials in the library full of videos, instructional videos on there. But I think when you're looking at a private equity fund, the fund manager is first and foremost very important, right? So you want to look at what is their background. Like, are they just really good at marketing? So I think that a couple years ago, everyone and their neighbor went into multifamily fund, for example, and a lot of them are marketers, right? So sometimes they're a radio host or this and that, but they don't actually have the chops of managing a fund or managing assets, and that's where things could go wrong. So you want to look for people or teams that actually have the professional background in finance and in law, in accounting, in asset management, portfolio management. I think that's very important. And then you want to ideally like meet them, somehow, like get to know them, just really assess to see if you have the trust with them, right? And then assess their track record. And you want to really understand the strategy. Like for me, I am so geeked out on investing. Like it becomes a little bit like a shopping exercise sometimes for me. I'm so interested in learning about so many strategies, but it's not possible to become deeply ingrained in all of them, right? So I have to stop myself. So for example, a lot of people I know are in crypto, but I don't have the time to really dig into crypto, to really understand it, to understand, okay, what exactly is the difference between Solana versus XRP versus this or that, right? So I don't then tend to invest in things that I can't devote or dedicate enough time to really understand. But the private equity space is such a big piece of the asset allocation pie, if you will. A lot of the very wealthy people, high net worth people, they made their money through investing in alts. So the private equity and a lot of these funds, they're under the banner of alternative investments. And so it's an asset class that I think you would not be doing yourself a favor if you don't learn. If I think if you're curious, if you have no inclination, fine. But if you have some curiosity, I think it's definitely a worthwhile asset class to spend some time to understand. And there's a lot of materials besides my own channels. There's a lot of materials that's readily available online that are very good. So yeah, I think it's a great asset class to dig into.
Yeah, for sure. We have some questions in the chat for you. Robert Kiyosaki talks about the cash flow quadrant. How do you break away from the micromanagement, do-it-yourself mindset of the quadrant to the trust and work above the business mindset of the B quadrant and I quadrant?
Yeah, that's actually a perfect question. And this cash flow quadrant is actually one of the slides and when I teach the masterclass on private equity. So I love this question. So we as a fund, we invest in land developers, right? So we're in the I quadrant. So that's the investor quadrant. We're professional investors looking at participating in real estate, in the subset of real estate through investing. So that's the I quadrant. I think when you're starting out, I think if you're starting out and you're in the active business of real estate, it's okay to just go through the quadrant, right? So go from the E to the S, right? So S would be someone that's like very hands-on, like you're literally doing the fix and flipping, for example. But or if you're, I don't know, a starter land developer, you could be an S quadrant. But I was talking about the way that we're choosing the operating partners. We're looking for operators that have the mindset of the orientation. It's a mindset thing where you can go scale from S quadrant to B quadrant. So that's hiring people, having systems, right? So that's when you migrate from the S to the B quadrant. And I myself went through the cash flow quadrant as well, because working as a lawyer, even though, I had a high salaried income in my 20s, that's still the E quadrant. So going from E to S, because everyone, when they're starting out as a startup founder, as a first-time entrepreneur, you're in the S quadrant. So that's just making money through your skills. But once you have figured out a worthwhile thing to work on, and you start to see a lot of demand, that's the product market fit, you want to start to implement systems that can help you scale. And then so soon after that, in the B quadrant, you have systems and you have other people executing on the work for you. That's a B quadrant. And then from there, like really stash away your capital, start to invest, right? Start to do your personal investing journey. On my YouTube channel, I share very openly about my own journey actually going through these four quadrants. So I think going from the B to I is a matter of changing the mindset, expanding, not so much changing, but I would say expanding your mindset, because a lot of the I quadrant people, they continue to be in the B quadrant, and just learning as much as you can.
So they can find out more if they want to know more about this, you working through the quadrants and the mindset and everything that you did along the way. They can check out your YouTube channel.
Yes. Yeah, I'm gonna drop in my website.
Yeah,
here.
please do. Please do.
Yeah.
We have another question from Wes. How do you ensure that the home builder will buy the 500 lots you are developing for them? I know there's a contract, but
Yeah, that's another great question. And so the way we do is that we have the contract in hand, but at the same time, we actually shop it around for backup buyers. And typically the contract is not honored if there's some type of macroeconomic change, because like I said, things are changing very rapidly. So in 2 years and 3 years, well, who knows, maybe DR Horton wants to build a certain product type and not other product type. So on day one, we make sure we have that contract in hand, but we also line up backup offers or backup potential offers where we will go to Toll Brothers, we'll go to, a couple other home builders and say, hey, this is what we're doing for DR. But in case that, in 2 years, they're not able to take down the entire 1,000 lots, would you be interested in taking down 250, right? And so that's one way. Another way is that when we're presented with the opportunity to do a very big project, sometimes we just break it into two, right? So we break it into two where right away, it goes from doing 500 lots for one home builder to doing 250 lots for two home builders. So you're mitigating and spreading out your risk. And at the same time, you would be glad to know that the home builders actually, in addition to signing this contract for forward purchase agreement, they actually have to pay a deposit down as the projects get developed. So it's called a takedown schedule. So every 50 lots that we finish and deliver to them, they have to pay towards that deposit. It's typically between 10 and 20% of the sale price of the whole project. So very much they have skin in the game from day one. So that's just, we try to layer on as many of these risk mitigation measures as possible.
Yeah. How is that having two builders building next, like, are they building next to themselves? If you like take the 500, divide it in two, there's 250 each. Are they right next to each other and there's two builders building next to each
Yeah,
other?
yeah, it could be. Yeah, so it depends on the site. It depends on the site, it depends on the negotiations. But the risk mitigation is because then you have two builders paying down the deposit, right? And
Yeah.
yeah, and you're spreading the risk that way.
Yeah. Yeah. Do they mind building next to each other?
They not necessarily, because sometimes it's two different product types, right? So maybe one builder, they're building like very entry level homes, and then maybe another builder, they're doing fancier stuff, like move up stuff. So it's very location dependent and situation dependent, but I'm just naming kind of potential scenarios.
Yeah. We have a few more questions in the chat. Jeff says, what's the greatest lessons you learned that can help folks get started?
I think that investing is kind of like riding a bike. You can read about it, you can watch other people ride a bike all day long, but until you start to do it, you don't really get that visceral understanding of investing. But once you start, then you can start with a smaller amount too, right? There are funds or syndications that will take $25,000, $50,000. Like our minimum is $100,000. It's not super high, but it's not the lowest either. But I think the importance is actually just to try, like just commit to learning and commit to trying. I think that's the most important thing.
Okay, we have 5 more minutes and we have a few more questions in here.
Sure.
How long is the fruition on the build outs from start to payday?
It depends on the project size. So some master communities are huge, right? So obviously the bigger the community, like, something that's 2,000 homes will take quite a few years. But we typically look for projects that are shorter term. So as I said, 24 months to 30 months. For our fund, it's mandated that we don't go over 30 months. And it's because we want to make sure that we return not only the investors' principals, but also give them a really good return within a relatively short time. So, for us, for our investors, we're looking at returns in the high 20s per year. And so when they, get their money back shortly after the 24 months, shortly after the 30 months, they can expect, quite a nice multiple on their original investment.
Okay, yeah, the next question is, what is the expected range of returns? You said.
Yeah, so if you go to my website, you will see a link to our company website. I'll just put it here as well. We're Pender Hastings Capital, so phcfunds.com. And from there, you'll see the investor portal, and the range is 25 to 27% IRR.
Last question real quick. What is the best transition process from learning to doing as a new investor raising capital?
I think you want to understand the fundamentals of a syndication or a fund, and as well as this asset class. So I think that's first and foremost, you have to have that knowledge. So again, like I said, please go ahead and check out my website and my YouTube channels. There's a lot of educational, materials out there, and you can start to read books. You can start to look at other people's materials too. And so I think from there, then you can ask yourself, okay, what is a strategy or what is a real estate asset class that I'm very passionate about and I have an advantage over others, right? So if I were to execute on this thesis, I have some sort of unfair advantage. And then, build a team. Like you might be really good at marketing or business development and talking to investors, but maybe, you will have a partner or two. They're very good at the operations, at asset management, at the finance stuff, at the legal stuff, right? So you want to build a team, and then you want to find a strategy that you can execute on, and to present that as a project that you're representing, or a fund you're representing, and that's how you cross over from just being an investor into the GP realm.
Great advice. Yeah. So last question, by high 20s, do you mean plus 20% returns?
Yeah, 25 to 27%.
Okay. And then that was quick. So this is the last one. Is this best to invest through an IRA? I'm assuming no tax write-offs.
Yeah, you are correct. We're all returns, no depreciation. And it is pretty high return. So one thing you could do is if you have a K1s from other projects, you can use those against our gains. And yeah, if you have IRA, you're welcome to invest through that. That's where, because of the tax sheltering effects, you really start to see an exponential growth on your initial investment. If you go to our company website, the phcfunds.com, and you go to our investor portal, you'll access our deck. Again, very great question. Right on the deck, there's a slide that actually charts that, what happens to your initial investment, let's say of $100,000 over time. So you really see that hockey stick. So in 10, 15 years, you really see that take off. Great question.
That was a good question. Thank you, Alice. I appreciate you coming on here and dropping so much knowledge and so much value. Did you guys learn a bunch from that? Type a V in the chat, please. Alice, you did such a great job. Thank you. Thank you. Round of applause. And we can find you. You dropped your website, phcfunds.com. Is there anywhere else they can find you if they want to find out more? What's your YouTube channel you were talking about?
Yeah. So if you go to my website, alicechencompanies.com, you'll find a link over there.
Okay, so it's a different website. If you want to drop that one in for everybody, that would be fantastic, so they can find you on there. Thank you again, Alice.
Okay, thank you. Yeah, great talking to you guys. Okay, bye.
Wow, great job, Alice. Huh? Man, tell you what, everybody, I want to tell you, there's a lot of stuff in here. I'm trying to remember it all, and if you haven't got the VIP for the recording, make sure you do before the end of the day. Great presentation. Thank you guys for that.